Okay, good evening, traders. How we all doing tonight? Sorry for the little delay. I had a couple of technical difficulties logging in for some reason. I don't know what was going on. So that happens from time to time. Looks like we got a good group here tonight. Excuse me. What we're going to talk about tonight with the P3 Method Krewe is our third part of the method, P3 of the P3 group. Let's see, gotta change it to price cycles here. And just making sure I have the right presentation. Yeah, it looks like I do. And I'll probably rework it, but I just wanted to throw something in a little bit differently this time. But let's share the screen and get started. Let's start it up and share this. All right. And tonight, unfortunately, I have to make this a little bit quick. I won't be able to get into the chart, into the alveo charts tonight. We've got family over, and there's probably going to be noise going on. My wife is needing my help tonight, so I'm gonna get through this presentation, answer questions. And then those of you who are in the apiary trading room as well, will go through some specific trades that I'm looking at with this P3 Method Krewe. But as always, any trades that we do talk about are educational purposes only, not meant for investment advice. And you guys know who I am, so let's get started. So as you know, we talked about 2 weeks ago, we talked about protection of capital. Last week, we talked about pivot points and how powerful those guys can be. Let's pull up the chat here. Hey, everybody and participants. And then this week, we're going to talk about price cycles. And it's kind of all combination, right? It's hard to separate each three because they all kind of combine together. And so when we talk about price cycles today, I'm mainly talking about how there's different methods that we can go about calculating those or looking for those. And I want to talk about the importance. And we'll talk about the money management technique that I use as well, the different money management techniques that I use to make these things work together and make profitable trades in any market. It's really, really fun. So I wanted to play a little bit of Jeopardy in loving memory of our Alex Trebek. The category is price cycles. Do 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 do, or do 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 do. That's Wheel of Fortune, isn't it? Oops, wrong. Mixing my stuff. So for 200, the distance between pivot points, major or minor, measures this. Anybody know? What are price cycles? There we go. Next. For 400, traders use these to determine how far a losing position should go and where to place their stop. What are price cycles? Yep, we can use price cycles for this too. The next one, for 600, these can be used to easily determine what a trader's risk-reward ratio is, or should be, or can be. What are price cycles? Gee, I'm detecting a pattern here. For 800, traders can use these to calculate the number of layers and how far apart they should be. What are price cycles? Okay, you guys are getting the picture here, right? Understanding how these work in the markets can help traders manage all components of their trade plans. Price management, risk management, money management, trade management, and even self-management. Stephen, Mr. Thompson, do you got it? Price cycles, you got it. All right, that was probably the easiest Jeopardy that you'll ever see, except the one on Groundhog Day, right? I think I could answer those questions too if I ever saw them. What is Lake Titicaca? Right, that's such a good movie. So priceless price cycles, they really are invaluable in our trading. They're so priceless. The question is, can they really answer all those questions? Right? Can they really determine the distance You know, for our stop losses, can they really help with risk reward? Yes. Are they really that important? Yes. So the question remains, how do we calculate them? And how do we actually apply? How do they apply to building a position? How does this actually work? Now, this has taken some finagling, you know, and this is, I don't think this is original per se. You know, I got a lot of these principles from watching Sean and the Wobble, and I'm sure there's other traders out there that do these type of methods and uses. And I'm sure the big boys that have lots of cash and lots of money to invest apply certain scaling methods and wait for certain locations. I'm just dumbing it down for us small fries, right? But when it comes down to it, I think price cycles, my learning these price cycles has made my trading so much more easy. And not just from a chart perspective, but from a psychological perspective, a self-management. Steve's like, woo, I win. That's right. All right, so calculating price cycles, there's obviously the pivot to pivot to pivot. What's the average distance? Okay, we can look at a chart like this. There's different methods. So some of you have probably watched Sean with his method. It's quite brilliant. It's just a little bit, I'm lazy, you know, it takes time to do the way Sean does it. So I'm kind of lazy, but basically from pivot to pivot, measure pivot to pivot, measure pivot to pivot. You see that? Measure these moves back and forth. And not necessarily the pivots. It could be highs to lows, you know, just market moves here like this, not just those little tiny things. You know, you get these market moves and you can calculate, and maybe the more you do these, the more that you can pull these arrows aside and find a base cycle for a market. Now, this is an hour chart, but you could do this on any time frame. How many times do I say that? Any time frame, you can calculate its price cycle. And so looking at looking at the pound dollars price cycle here on the hour, if we took enough of these, we'd probably get an average on the small. If we had like a category A, right? If we had a category A of small ones and then a medium sized one of B and a bigger one of C, we could calculate that a lot of A's. We'd probably get a lot of A's and we get a lot of B's, and we get the occasional C's, right? And we wouldn't get a ton of them. But what we would find is that if the A's measure about 2, then the B's are going to measure about 4, and the C's are probably going to measure about 6 to 8. You're going to see that there's these smaller ones are like a base cycle, a baseline cycle. And with method B, this is method A of finding different price cycles. With method B, you can do the same thing, but just, and I'll show you here in a minute. You can do the same thing. And depending on the price cycle, you can discover, okay, how many pips is that exactly? All right. So what's method B? Method B is drawing lines at each of these pivot points. So I draw a line there, I draw a line here, and then another pivot shows up over here. I draw a line here and more pivots show up over here, right? So you see the distance between these lines like this, you see that? Becomes an average price cycle for that H1, for that hour one chart. Now, again, if you wanted to find, even more precise or even smaller price cycles, you could do something like this. You see where these pivots are? You can cut this in half. You can cut this one in half and see pivots there, and cut this in half and see pivots there. Last week we did an exercise. Mark, couldn't you use ATR for this? You could, You could technically, but the thing is ATR only measures the range of a candle, the range of the candles over a 10 to 14 past candles, right? And it could give you that those average price cycles, right? But there's another reason to break it out this way. There's another reason to break it out this way with method B, in my opinion. With method B, it gives me the ability to, well, if this is the distance between these lines here, or even a major one right here, and I'm maybe testing a breakout, where could this go? Well, I'm just going to measure that distance and draw another line right there, right? Now, an ATR could give you that, but it might not, depending on the volatility, and it might be a consolidation right in here, and it might be really small, right? So it's close. But the other thing this does is it gives me areas to engage the market. See that? ATR doesn't do that for me. Okay. These lines give me, and in conjuncture with the pivot points. So Mark, if you were here last week, weren't you, with the pivot points? The pivot points in conjuncture with these measurement of price cycles, even if it hasn't traded in this area and has any pivots, well, if we measure this price cycle, we could probably get some pivots. If the market decides to go up to this point, it'll probably pivot there, maybe do some cycles based off of these measurements in between. That's the power. Oh, first time here, Mark, I highly recommend going and watching last week's recording about pivot points. Oh man, pivot points are awesome. And in fact, we'll probably, maybe if I have some time, I've got 15 more minutes here. If I have time in the chart, I'll show you that. But these price cycles in conjunction with these pivot points help us identify a little bit better, in my opinion, than ATR. And the same thing, same thing with Sean. He wouldn't go through all his work if the ATR could just do it for him. All right, so using these calculations, if we have a base price cycle, let's say on the hour chart, we have a base price cycle of 35 pips between pivot, major pivot to major pivot, right? And we get these, this market going up like this, and then between these lines, that we're able to do, it's about 35 pips on average, right? Every major pivot we find. So let's call that our base price cycle. Let's say that we use a max risk of 1% on our trade. We're going to look for the previous pivots. We're going to look for the previous pivot, high or low, and use that amount, that base cycle average, as a setup range. Now, technically, you could risk 2%. General rule for me, general rule of thumb, I'm risking 1% per price cycle. So if I'm looking at a chart, I'm like, I want to have this setup range be 2 price cycles, then just naturally in my mind, I'm going to be risking 2%. I'm going to do that the same way. Based off of that 2%, and based off of the fact that we have this setup range of 35, is this making sense, folks? So, and I'll show this on the chart. We've got, let's say the market's coming down here like this. It pivots, makes another pivot right here, maybe halfway, and then it breaks it and starts to come back down. And I say, you know what? I think this market is going to continue to go up. This is a previous pivot here, a previous pivot high, but this is the previous pivot low. So when I'm saying the previous pivot high or low, this is where I want to enter to go long, right here. But I don't know if this market is going to bounce right there. How many times do we get in on a trade at that type of spot? It's like a perfect spot. It's lining up with a trend line. It's lining up with a previous resistance. It's in an uptrend. But the market, man, I did the wrong colors there. Maybe I'm infiltrated by China. The red is good, green is bad, right? I'll just keep it. But if the market comes back in this setup range, this is what I'm calculating in case I'm wrong about this entry, in case I'm wrong that that's the entry the market will keep going up. If a market keeps coming down, I have a setup range. I have a price zone. I call this a price zone as well. Price zone. This is my price entry zone where I'm going to risk 1%. And then basically I'm going to be able to determine what my max position size is based off of the pip amount and based off of the size of my account. Obviously, you know, I need my account balance, right? The account balance, the stop amount, the risk amount, and then that will calculate my position size within this risk, and it'll tell me how many layers I can do if I'm going to layer in this trade. Okay, it'll tell me my max position size is 35 pips, 1% on a $10,000 account. What is that? 1%. I thought that's 10%. $100. So $100, and then 35 pips. I mean, I could throw LVO up. I don't have LVO down here. Maybe I do. Let me see if I have LVO. Yep, it's here. Okay, let me see if this logs in here for me, and then once it does, I'll pull up the one-click trading on Alveo does this calculation for us. Okay. But this is the idea. This is what the base price cycle does. It helps me calculate based on my risk, which I've learned from previous class, right? We got to predetermine that and protect our capital. And we have to determine that based off our averages. And I can find, okay, based off of this, oh dear, here it is. So bring this over here. Okay. Let's see. Let me just share this Alveo here and show you. Let's see if I have a $10,000 account somewhere. So if I have a 35 pip stop, I want to risk 1%. Can everybody see this down here? Let me bring my my drawing tool. Can everybody see this? One-click trading. So Nick did it, 0.28 size lot. So that means at a point, at a 0.01, I can do 27, right? At 1% on about a $10,000 account. So this is a little bit less, so that works. So that means, going back to our setup range. Well, let's just do it right here. Let's just say that right here I want to go long. Let's say that right here I want to go long on this. So you see how I already have my lines here? I was teaching somebody here. So this is a 5-minute, but let's just say this is my pivot right here. Well, we can measure 35 pips. How much is that? About 40. That's perfect. That's just what we want. It's just what we want right here. So let's get rid of this. Let me move this down here so I can actually use it. Okay. Stephen, can one be a successful trader without understanding the math and technical? Yes, absolutely. Absolutely, you can. All you have to do is be able to draw a box and say, look at this right here. This is where I want to go long. And the fact of the matter is that one-click trading tool does all the math for you. All you have to do is decide how much risk you're going to put in. Okay. And then from there, if this is where I start to build my trading, I know at 35 pips of range, if I got in all right here, my 1% of risk, at 35 pips, if I used all of my 1% of allocated risk, I would be able to put in 0.28 lot size right here. But the way I trade and way this method works is this is my setup range of 35 pips. So I'm going to get in on a small one, even if it's maybe 3. Maybe I'll get in on 0.03. Then if it moves based off of this 35, I'm just going to divide it by 7. I'm going to try it. Let's see if it 7 layers. What's 4, and then 5? That's 12. 6 is 18. 7 is 20. Oh, my brain just it's 25, and then 8. Maybe we could do 6. Because I know that most of these trades are closer and have a stop that's less than 35. So I know I'm going to be in. So there is a little bit of math here, but I never really have to calculate it because I just know with practicing this so much that as long as I stay within a certain amount of 0.28 on this position, I'm going to stay within my 1% risk. And then I stop myself out right there. Okay. So if I spread this into 7 layers, or I guess you could say at 5 layers, and then it's every 7 pips. 1, 2, 3, 4, 5. So every 7 pips, which is if we measure these price cycles here, we do this, and we do this, and we do this, and then we do this. It's about right there, and about right there, and about right there, and there, and there. And I just cut these in half. You can see that I'm finding pivots at these halfway points. See that? And if we measure these, it's about 7 pips, isn't it? So all I have to do is do these. So all of this is coming together. This is the class that brings all 3 of the P3 method together, protecting capital, using pivot points and these price cycles to determine how to get in these trades here. So my entry is at this pivot, and then my next entry is at this line, next entry 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 at this line. I guess that's 6. So 6 would be, what is that? 5 layers, almost 6 layers at 6 pips a piece, about. It doesn't have to be perfect. That's a great thing about this too. It doesn't have to be perfect math. We're not building a bridge here. You know, we don't have to be engineers. We don't have to be perfect with our math in order to get this right, because guess what? The market's going to be moving all over the place anyway. And if you expect perfection, you're going to be frustrated, and you don't have to be perfect to be profitable. Okay. I tell that to myself all the time because I get that perfectionist. Yeah, it's not rocket science. It really isn't. And it just takes some discipline. And rocket scientists have a hard time trading because they have to be perfect, and the markets aren't perfect. But anyway, do you see how this is coming together? Let's clear this. So let's and make it a little bit. So 28. If I start my entry here, I could start at 0.02, and then here at 0.03, and 4, and 5, and 6, and 7. How many is that? 2 and 3 is 5, 9, 14, 20, 27. I can do 0.28 and still be within my risk. So if I'm layering in and I cut it off right here, I'm well within that 1%. I could probably even do like 15 at the bottom here and still be within my 1% risk. And I've done that before too. And this is based off of this pivot over here. And it's like, okay, well, it's in a big uptrend. I'm just giving myself a chance. If it comes down to here, it'll probably bounce at some point. It bounced there, it could bounce there, it could bounce there, it could bounce there, and I'll make money even if I'm wrong. And that's another thing that I love. I love making money even when I'm wrong. I'm wrong a lot on my first entry, and maybe even my second entry, maybe even my third entry. But at one of these points, if the trend stays and everything works out, and more than half the time, one of these times the market bounces and those entries work. And really, I could make money right here. If the market bounced right back up to here, I'm making money because I'm scaling in the way I am. 2, 3, 4, 5, et cetera, et cetera. And yeah, this is kind of like a version of the wobble, but it's definitely not the scalping wobble. It's definitely not the wobble. We have to stay within, you know, Sean has unlimited amount of trades and risk that he can do. I mean, I've seen him down 30% before. You know, we don't have that luxury. We have to stay within our certain risk. So let's just allocate a certain amount of risk. And then we can easily calculate based off of price cycles. Let's go back to our thingamabobber here. Based off our price cycles, we can discover these setup ranges and calculate the position sizes, the number of layers and the distance between them using price cycles. It's awesome, folks. And then how do I do my price cycles? Well, you use the pivot points. I'm showing you some pretty valuable stuff here, folks. It's awesome. Also, if you like, send me an email, or you know what? Better yet, I'll put this link in the discussion on this class's on the calendar discussion underneath the enter into the room. And by the way, if you haven't put in a comment on one of those classes yet today, you'll get 200 street cred for doing so. I'll put this little wobble planner here. I don't want to go into it now because I don't have time. I want to get through this. This works with any time frame, folks. Oh, I guess I could paste it in the chat. Give me a second. Whoops, I didn't want that. I want this, and I can grab the link and post it in the chat. It is something that one of my traders made for us, okay? All right, let me get back out of that. Resume. Okay, so these are different ways that you can add to the position. This is the way that I commonly do it, is through the fade. You can also build into as your trade's going in your direction, and you can allocate your risk that way. We won't talk about hedging too much, at least right now. I'm still working on a good way to calculate it and make it understandable. I'm still not good at it and perfect at it yet. Finding the right place to start a hedge, et cetera, and how much. Usually I kind of do about a third of a hedge. If a position is going too far against me, I'll hedge it by a third. And then if it does come back in my direction, I am kind of leaving money on the table by leaving the hedge on, but it just protects the account. But I won't get into that anymore than that at this point. All right, so yeah, we've got an uptrend here. We've got the market coming in like this. If I want to go long, and I've got my setup range right here, right? And this is how I add. This is what the fade is. Oops. Okay, so let's go back here. So this is where you add the fade, and this is where you add the build. You could do one or the other. You could say, okay, well, I don't want to add to this position until it starts actually going in my favor, right? And so I just by nature I'm contrarian, and so when I just fade into the downtrend, expecting it to keep going. So on a chart, this is what it looks like. We've got our support. We've got our market coming down in an uptrend, and this is where you add during a build. Okay. I keep going too fast. You see that? So it comes up to here, starts coming back down towards this line, this old pivot line. I'm going to add into and this can be on a 1 minute chart. You can calculate this with your scalping. This can be for day trading. This can be for swing trading. This can be for long-term trading. Okay. It doesn't matter what time frame this chart is. If this could be a day chart, and you add a little bit every so often, you calculate this distance and say, okay, well, I need to add every 30 pips. And if it comes down another 30 pips, then I'll add another position. Okay. During that fade, or if it continues in that way. So trade allocation is really important. You have to determine your max lot size before you even start. So that little link that I put in the chat allows you to do so. You can put in, okay, well, I want to do this many layers, and I'm going to put in how much the dollar is worth. And again, I wish I could go through it right now. But it will help you calculate how many trades, how many max lot size that you have within your risk allotment, within the risk that you decide, whether it's 1%, 2.5%. Okay. So again, your max allocation needs to be based on where those previous pivots are so that you can determine a price range, and then on the percent risk of your account. Okay. So you need to know that before you're getting into the market. I've said it once, I'll say it again. If you do not know what you're risking before you get into the market in a trade, you shouldn't be trading. If you're just winging it, if you're just trading because you feel like it and it looks good, and I know the market's going to do this. How many times have I said that? I know the market's going to do this or that. And you don't know how much risk. I'll just play it by ear. I'll just get out when I feel like it's going to go against me. You're going to get out when you feel like it? What? You're never going to feel like getting out. You're never going to feel like locking in a loss. You have to determine this stuff beforehand. And if you don't put in that work beforehand, you'll never make it long term as a trader. I promise you. I promise. It's too hard to manage. And so you make that decision beforehand. You make the decision to stay within the guardrails. You're going to the Grand Canyon and you tell your kids, and I tell my kids, do not cross the fence. The fences are there to protect us so that we don't fall over a 500, 600 foot cliff. And yet a lot of us as traders jump into the market and we're dancing on the edge, taking pictures. Real smart. There's a fixed allocation. You can add the same amount of trades. So when you're adding your fade, you could add 2, 2, 2, 2. That's kind of what Sean does at first. Kind of, it's more like 5, 5, 5. But then as it gets farther away, he's like 40, right? I don't do the fixed allocation. I like the variable allocation because it's my pyramid pattern, right? So if I'm doing 1, 2, 3, 4, 5, I know that the area of the triangle meets equilibrium. If the market's coming down like this, then the market just has to bounce right here if I've added them that way. And then I can get out at that. I can get out of that point at break even if I need to. If I see the writing on the wall and something's not going well with my trade, or maybe there's a news, something came out, I'm like, I need to get out of this trade with as small loss as possible. Or maybe I have to go somewhere and I don't want to watch the trade, and the market bounces up to break even. I'll hit that red X. I'm break even. I was wrong 1, 2, 3 times on my entries, but I'm a break even trader. I don't have to wait for it to come all the way back up here to break even because I put 20 trades up here and 20 trades right here and another 10 right here. And then the market keeps going down and now I'm held hostage. See what I mean? Anyway, the larger position size to a fade, the smaller position size to a build. Okay. So that means 1, 2, 3, 4, 5 on a fade. And then if it's building, you do 5, 4, 3, 2, 1. If it's going in your direction, build in with smaller lot sizes. That's what Jesse Livermore would do on his stocks. He would continue to add positions, but half the size, half the amount of shares. Okay. It's a very common thing. We'll get into that a little bit later. Oh, well, no, we'll get into it right now, just really quick. So here's your price cycle here. This is your fade, 1, 2, 3, 4, 5. And then as the market goes up, right here, you say, okay, this is where the support is. That's where I'm going to start with 5. And then if it goes up, I'll do 4, et cetera, et cetera, et cetera. Okay. Pretty much works the same, right? It's just if it keeps going against you, then you're at kind of a little bit more risk doing the fade, right? Okay, determine before you start max fix the location. Did I duplicate that slide? All right. So the best way to use this method that I have found is finding a market with whatever time frame that you're trading. If you're doing a day trade, you want to look at a higher time frame on the time that you're day trading. So don't just do this on a 1 minute and a 5 minute. Look at a 15 minute or an hour chart and look for the extreme high or extreme low of that time frame as far back as you can go. Well, maybe not as far back as you can go. Maybe it's just the last month or two or the last month, right? And if you're coming to a market, if you're coming to a pivot, where's my drawing? If you're coming up to a market like this, and the last couple months it's been in this range, that's where I'm going to find my price cycle. I'm going to start selling into that and use that above area in case it breaks that. So instead of playing a breakout trade, I'm going to fade that breakout because 70% of breakouts test the breakout. Okay. So I want to find that extreme high, or if the market's coming down and doing the same thing, I want to find that extreme low. I want to buy into support. I want to sell into resistance and use that price cycle to determine, okay, I've got that much room, or maybe two, if I want to do 2.5% risk. And I do it on the low side too, build that price range down there. It doesn't matter what market, folks. It does not matter what market. Find a market that you like trading, find its price cycle, look at the pivot points, look at the support and resistance areas. When it comes to an extreme high or an extreme low on the time frame that you trade, you locate that previous pivot to find that range and saying, okay, well, if it breaks that pivot, essentially finding that pivot that if I want to be a buyer, right, in this uptrend, this is actually a continuation trade. So there's different ways that you can do it, but I'm going to look at that extreme low and make that my setup range on the continuation. On a counter trend, right, where I'm starting to sell into that instead of waiting to buy into it. There's different ways that I look at, and I need to make sure I include that in one of my classes in the next few weeks. There's counter trend with the P3 method. There's continuation, and there's also consolidation trades. There's 3 types of trades that I look for. Okay, so the C3. Nick says, oh, ding, 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 light bulb. What was the light bulb, Nick? Make sure you write that down. So there are times where I'm selling into against the trend. I'm selling into the trend at resistance and using the price cycles as my cushion in case I'm wrong at the first resistance, right? And then there are times when I'm in a trend and it's coming down to a spot. I'm like, I'm going to buy this. This is easy. The Kiwi CAD's a good example of that. The Kiwi Swissy, I'm long on. Those are continuation trades right now. Counter trend right now, I'm shorting the Aussie Kiwi. I'm buying the Euro pound. I'm selling the Euro dollar, selling the pound dollar, and selling the pound yen. Actually, the pound yen. No, the pound dollar is doing pretty good. Where are we at? 06, that's good. Okay. Anyway, and then consolidation, we can just, if we notice we're in a consolidation, just sell into the top, buy into the bottom, right? And then use the price cycle as your cushion in case it has a breakout, and then we'll talk about that. In fact, maybe next week I'll do this method with those 3 types of trades with the C3s. So combine the P3 with the C3s. How's that sound? That will make a little bit more sense with these things. Calculate that price cycle of the time frame, determine your risk, how many trades, how many position size you have, and bada bing, bada boom, you've got a method, a process that is repeatable, that is profitable, that is fun. It is hard. It takes practice. That's what I'm here for, to teach it, right? But I tell you what, using price cycles, using pivot points, and always with the mindset of protecting your capital, this P3 method works. And it works in any market. It works meaning it helps you become the trader that you want to become. And it makes trading great again. Pardon the pun. You know, I don't mean to be political, but I mean, we hear that all the time. But there's a lot of folks that I talk to that, you know, trading isn't fun anymore. It's hard. I've just been beat up so many times. And I can relate with that. I've been beat up plenty of times. But doing it this way, looking for a market's price cycle. And if you look at last week's lesson, oh, good golly, those pivot points and price cycles, a market sticks with its price cycle for years. We went back 2 years on, was it the pound dollar or was it the euro dollar? I showed it today in one of my trading sessions with a trader. I was showing her this, and we went back 2 years on the Kiwi dollar, on the New Zealand dollar, US dollar. And we went back 2 years and just plugged in on the day chart and plugged in all the little lines. And then we pulled up the 15-minute chart today, and bada bing, bada boom, those pivot points were happening right at those same lines. Okay. If you don't know what I'm talking about, you missed last week's, go watch the recording. It's phenomenal. It was mind blowing. Okay. And yesterday's trading room, we talked about it too. It was a lot of fun. Yesterday's P3 trading room, P3 method trading room. All right, folks. Really fun stuff. Trading's awesome. You're all awesome for showing up. I want this to be the best crew, the most talked about crew. It probably won't be. You know, I'm competing against some awesome traders. But I really do believe this is a method that can be applied, because it really provides the fundamentals. It can be applied to any type of trader, any time frame, any market, and I'll stand by that because it's helped me see profits in my account much easier than in the past. I've traded some really risky strategies in the past and done pretty well, but I've had my you know, I've been taken to the cleaners too, you know, because I didn't have this. I didn't have a nice method to follow. And I still make mistakes, but they're much less frequent and they're much less devastating because of this method. All right. So with that, Patrick, thank you for your time. You certainly do, but that's okay. We all still do. It's the learning process. Appreciate you coming. Superb class. Thanks, Norma. I appreciate that feedback, especially coming from you. You've been to lots of classes. So that's good to hear. All right, folks, I got to sign off. But if don't forget, if you haven't got your street cred today, go ahead and in the calendar under that discussion, put in a comment, something that you learned, something that you're going to change, an aha moment, a light bulb, and we'll see you next week in the trading room. If you're with Apiary, if you're a trader with Apiary, we'll see you tomorrow morning. We're going to actually go through a lot of the trades that I have going right now that are looking good. So as long as they keep going their direction overnight, they might not. That's trading. All right, folks, keep on trading on. Now have a good rest of your week and your weekend, and we will talk to you next week. Nikita, how do we get street creds? Go to the calendar and then zoom and then scroll down where you came to come into the room. Scroll down and there's a discussion board. Just type in a comment and you should get 200 street cred. Okay. All right, folks. Hope you have a great one. Take care, and we will talk to you next week. Okay. Bye-bye.